Hey, everybody, John King with Summit Funding, and appreciate you joining me for my Financial Friday live broadcast. I do this every single Friday, and I am broadcasting on topics that matter to you about your personal finances, things that you need to know about everything financially related. So, today is a topic that I'm going to be covering that is near and dear to my heart, and it's really our 6 steps to financial freedom. And this one is really, really important to me because it is something that I've spent the last 20 plus years helping people get into debt. And the reality is that we never talk about how to get out of debt. We never talk about steps to handle and manage your finances. And the truth is, we're not taught this stuff in school. We all go to school, we get a degree, whether it's high school, whether it's college, we're taught economics, but none of that is really applicable to how do you manage your day-to-day financial life. And I think it is critical that people get a better education on their finances, and I'm committed to helping you get that education. So this hour, hopefully interactive. I've got some people popping in and out right now. So as people are joining my live stream, please feel free to post questions in the comments, and I'll reply to them, and I'll bring those questions on. If you are watching the recorded version, post the questions there as well. And I'll get back to them. I'll see that you've posted a question, and I'll be able to respond to you. And really, my goal is to make this as interactive as possible and helping you to grow your financial future and helping you to be stable in your finances and how we think about things, especially in these crazy, crazy times that we're dealing with right now. A lot of economic uncertainty, a lot of ups and downs when it comes to people's emotions about finance. And that's really the first thing that I want to remind you is money is tactical. The problem is that money is most people tie a lot of emotion to it, and I understand why. And I'm not telling you that it's easy to shift it to being tactical, but statistically, money is the number one reason for challenges in marriage and divorce, because people disagree about money and it becomes an emotional issue. And what I want to go through today is some ways in which we can look at money tactically and think about it in a way that isn't going to have a whole bunch of emotion tied to it. So I'm going to go ahead and get started. I've got a presentation here that I'm going to use as my way to walk through the 6 steps to financial freedom. Because as I mentioned, I'm going to help you. If I haven't already, I will help you get into a huge amount of debt, and that is your mortgage, and that's good debts. But now I want to help you to get out of it as well. So let's get started in talking about the 6 steps to financial freedom. The first thing is, what are our objectives? My goal is to talk a little bit about budgeting. Now, budget is a bad word. Budget is a 4 letter word. Most people think of it, oh my God, John's about to tell me where I can spend my money. Actually, I'm about to do the opposite. I'm going to help you understand where you spent your money, because visibility is key. And I have a lot of people who are telling me, John, I have no idea where my money goes. I get to the end of the month and hopefully I have, more cash than month. And that I get to the end of the month and I have money left over in the bank and I just kind of cross my fingers and hope. And that's really where the budget that I'm going to be talking to you about is one that gives you visibility. Where did my money go? Did I save any or not? Did I um, improve, or did I move forward? Did I move backwards? It's just a scoreboard, but it's a super important scoreboard that helps you to pay attention to, am I winning the game? Imagine if you played a game. I don't care what the game is. Let's pick football. And if you were a football player and you were playing a football game and there was no scoreboard, how do you know if you're winning or not? How do you know whether you've done a good job or not? And so the budget that we're going to talk about is going to be that scoreboard. It's going to be the way for you to track and pay attention to, where am I at financially? And if you complete this on a monthly basis, it really gives you a good starting point to pay attention to where you're at and where you're going. So by the way, I've got a few people that are live on a few different platforms. So if you're joining me live right now, go ahead. I'd love to see who's here. So if you could post in comments and say hi, John, and if you have something that you'd like to get out of this webinar, I would love to hear it right now. So give me a shout out and say hi, John, if you're watching me. And I know there's a few of you out there right now. Um, and if you choose to, tell me what it is that you would like to get out of um, this class about financial freedom. All right, so moving on, we're going to talk about tools to manage your money, and then we're going to talk about ways to see what you're spending, how much you're saving, and begin to see improvements immediately. I'm going to start with a game. So I want to play Budget Jeopardy. And for those of you who are on live, again, I've got people popping in and out live. If you're on live, feel free to post your guesses on these questions, and we're going to talk a little bit about money. So first question is, what percentage of Americans live paycheck to paycheck? So what do you guys think? I'm getting a few different answers in here. Make sure if you got a second, if you're watching even the recorded version, post right now what percentage of people you think live paycheck to paycheck. Yeah, I think a lot of you are going to be surprised from the answers that I'm seeing. 70% of Americans live paycheck to paycheck. And really, there's a few different ways that I look at that. The first thing is that for those 70%, hey, you're normal. Like that's part of where life is, but part of it has to do with the fact that you have no process to evaluate your money and be in a point where you're not living paycheck to paycheck. And so what I want to do is to help you to shift from being one of those 70% to being one of the 30%. So the next question is pension. I think a lot of people think about pension. Years ago, pension was your retirement plan. It was the way that you planned for retirement, and that really has gone away. As a matter of fact, 50% of the workforce has no pension, and for a lot of that people, that also includes 401ks. There's a lot of people who are working right now, if even if it's not a pension by definition, there are a lot of people who don't even have a 401k. So you're in a position where you're not thinking about your future, and I get it because sometimes the today is so overwhelming. So I don't want this to be a negative Debbie Downer. The reality is, at least half the people out there have no pension. They're not really planning for retirement. They're thinking Social Security is going to take care of me. Well, let me tell you, as the next statistic says, when Social Security was first created, the average life expectancy was 62 years. If you know, what do you think, guys? What is the average life expectancy right now? Post me your answers. What do you think? Yeah, 80s. Okay, so the average population is living significantly longer compared to when Social Security was created. Social Security is a part of your retirement planning. It's part of your budgeting when you think about your financial world. You get a statement now every single year from Social Security. Read it, pay attention to it, think about it. If you're in a position where you're ready to start collecting Social Security, you absolutely need to talk to someone who is going to be able to give you really good advice on, should I start collecting Social Security now or should I postpone? And I'm actually going to be doing a webinar, I think in about a month, where I'm going to talk about retirement planning when you're ready to retire. And we're going to talk about Medicare. We're going to talk about Social Security. We're going to talk about drawing money out of your 401k, and minimum required distributions. And we're going to be covering a lot of that stuff because I think these are things that are cryptic. Nobody really understands how it all works. And even if you're not ready to retire, the truth is you're in a position where you've got to think today about, what money am I going to have for my retirement? Okay, you kick a little bit of dirt into the hole right now so that things are better when you're retiring. We work really, really hard for a majority of our life, and we do that so that we can ultimately provide great things for our family, live a great life, and then be able to retire and enjoy our retirement. And I talk to so many people right now who they lived paycheck to paycheck while they were working, and now they're retired and they don't know how they're going to make ends meet. And one of the other things that I think is becoming a very important tool for retirement is reverse mortgages. And that's a super scary word for a lot of people because there's been a lot of problems historically with reverse mortgages. They've been abused, they've been used incorrectly, and people, don't understand how they work. And I'm going to be doing a class in the next month about reverse mortgages as well on this Financial Fridays to explain how they work and what the benefits are. But I'll give you a quick 10-second preview. A reverse mortgage is a perfect scenario for someone who has a lot of equity in their home, but doesn't necessarily have a lot of other assets to help them with retirement. And as long as you're 62 years old or older, You can tap into a reverse mortgage, and that lets you pay off your mortgage and never have to make a mortgage payment again, and often will allow you to access additional money depending upon how much equity you have in the home. And the mortgage gets paid back when you sell the home, when you have to move out of there, or for example, if you have to go into a retirement facility permanently, then you've got to pay off the reverse mortgage. Hi, Anita. Um, so I appreciate Anita gave me, I'm going to post this up here really quick. So Anita said she wants to enhance her financial goal setting skills and her retirement plan. So that is perfect, Anita. That is right on track with what we're going to be talking about here. So thank you for that. Anybody else who wants to give me some shout outs on why you're here or what you want to get out of it, I would appreciate that as well. So reverse mortgages, guys, is just one other piece of the pie when you think about how am I going to live once I retire and be able to enjoy my life. And so that's something I'll be talking about down the road. There are a lot of reasons why you shouldn't do a reverse mortgage. There's a lot of reasons why you should. So that's not the topic of today's meeting, but it really is the encompasses the big picture of what I'm trying to cover today, which is things that we've got to be thinking about, things that we have to have in our mind that say, hey, how do I help fix my financial picture today, tomorrow, and into the future? So let's keep talking about our financial jeopardy. So 62% of Americans retire on less than $10,000 per year of income. Okay, most people are simply getting Social Security income, and a third of the American population is retiring getting less than $10,000 a year in income. That's not even $1,000 a month. I talked to a client just recently who is in exactly this situation. Now, I ended up talking to her about a reverse mortgage, but she's got a property that's owned free and clear, and she literally makes $1,000 a month, and her property taxes are $500 a month. So there is not much money left over to do anything else. And that's what we want to help avoid through this process and through the education I'm giving you today. So let's talk about worrying about money. I think it's one of people's biggest worries. And so the next Jeopardy question is, what percentage of Americans always or sometimes worry about their money? Any guesses? What do you guys think? What percentage? Is it 100%? I see 50%. I see one person saying 99%. It's 55%. So 55% of Americans always or sometimes worry about their money. And worry starts with lack of information. When you don't know what you have, you don't know where it's going, you worry about it. And that's solved by just having visibility, by knowing sometimes visibility creates even more worry. But I'd rather worry about the truth. I'd rather know what I'm dealing with and worry about what I'm dealing with than to worry about the boogeyman in the closet that may or may not be there. And so, this process I'm going to teach you today is really focused on how do we stop worrying about the unknown and at least factually worry about the known, or recognize things aren't as bad as what you think. And it's something I say a lot. Life is never as good as we think it is, and it's never as bad as we think it is. And it's really about focusing on the reality. Another thing I actually heard this morning, and I read it in a book, and I thought it was really good, and I'm going to paraphrase it, and I'm sure I'm going to screw it up. But it said, we view our memories of things that happened in the past through the lens of what's happening today. Think about that for a second. We view our memory of things that happened in the past through the lens of what's happening to us today. So if you're in a place of joy and contentment and gratitude, your memory of what's happened in the past is going to see all of the things in your life that were joyful and content and filled with gratitude. And if your lens right now is one of fear and uncertainty and lack of gratitude, then you're going to see everything in the past through that lens. And those are the only things that are going to come to mind. So when you think about your money, the same holds true. When we think about the future of our money and where things are going to go, well, the environment that we're in, the stage that we're in financially in our life, that's the stage we're going to be viewing our future through that same lens and thinking that's how things are going to be, that they're never going to change. And that just isn't true. And I hope to help you in the next 45 minutes think of ways to change this. The next one, oops, I gave away the answer already. 75% of Americans fear they aren't saving enough money for retirement, but only a few are willing to do something about it. That's really what I'm trying to inspire you to do right now, is to think about that. I'm not going to tell you to sacrifice what you're doing today. I'm telling you to just be aware of what you're doing, aware of where your money is going, aware of how you can change your habits. And awareness is really going to be the key. So let's talk about some important facts. If you're 45 years old right now and you put $100 a month in an investment, and that investment averages a 10% return, in the next 20 years, so you're 45 years old, you have 20 years to invest, and you simply put $100 a month into a retirement account. In 20 years, you're going to have almost $72,000. But the next one is going to be even more amazing. What if you started 10 years earlier? Now, some of us who are older, you don't have a choice of rewinding, but what we do have the option is to teach people that are in the process behind us, to teach our children, to teach the next generation the power of compounding small savings. $100 a month, hey, that's a decent amount of money. It's not life changing. Nobody's going to think, hey, if I can, is $100 a month going to change your bills? Is going to change your ability to live the life the way you want to if you set aside $100 every single month? For most people, the answer is no. So if you start early at 35 years old, putting the same $100 a month, and you get an average of 10% return. I say 10% return, guys. The stock market has some years that it goes up by 25% and some years that it goes down by 5%, but the average is about 8 to 12%. So a 10% return is reasonable. And if you started at age 35, you have almost triple the amount of money. 10 years sooner, and $100 a month turns into $206,000. And if you started super early at the age of 25, you have a $500,000. So compounding interest is the key. Okay. So speaking of saving money, next Friday, I'm going to be talking about how to buy a home with down payment assistance. And it's funny because people will sacrifice their retirement account. Hey, John, I've saved $75,000 in my 401k, and I'm going to liquidate that money so that I can put a big down payment, because that's super important to have big down payment when I buy a home. And the truth is, it's not. It is really important that you let the money you put into the account grow. Maybe we take some of your retirement funds out, but what we want to do is we want to think about, should I put less money in my down payment in my home? It's going to impact my monthly payment just a little bit, but that's a tax write off because I get to write off the interest I'm paying on my mortgage. But right here is the key, is you keep that money in your 401k, you keep that money invested, and it allows that money to grow. Don't sacrifice your future. Now, sometimes that's our only way to make it work. And in that case, it might be necessary. And so it is really a key to your thinking about planning with your money, is everything has an opportunity cost. Just be aware of that cost and know that the sooner you're investing money and setting it aside, the better off you are. All right, so let's go ahead and keep going here. This is our money spending formula. This is really the key to what I've been taught and what I think really works. And it really is simple. We are splitting every dollar we make into four categories. Now, for most people, the bottom category, the 30% that goes towards taxes, I say bottom simply because of how the pie chart is written out. That 30% that goes towards taxes, that comes out automatically. It is withheld from your paycheck. You don't have to worry about it. It happens automatically. What I'll tell you is, if you get a tax refund every single year, you should rethink how much money you're having set aside for your withholdings. Because what you're doing is you're giving the IRS an interest-free loan. Now, for a lot of people, that's the only way that you can save. And I understand that, but that's hopefully through this budgeting process, we can get some discipline to say, hey, instead of giving the IRS, let's say, for example, that every year you get a refund of, $1,000. That's your average tax refund. Well, that means that you're giving the IRS $1,000 too much money. So you need to decrease your withholdings, and you need to decrease those by about $100 a month. About $83 a month is how much you need to decrease your withholdings. You can contact your HR department. You can contact a CPA and ask them to run numbers for you to help you understand this. But the first tip is, don't give the IRS a tax-free loan or interest-free loan, because right now the IRS is actually backlogged in issuing refunds. I've heard from clients who have submitted their tax return and they're waiting for the IRS to give them the money back. The truth is, you're better off subtracting $1,200, $100 a month from your withholdings. And now when it's tax time, you actually owe the IRS 200 bucks. No big deal, because you paid them 1,200 less, but instead of getting $1,000 refund that you have to wait to get and you're begging and hoping they send you that money, you've set aside $1,200 in a savings account. That $1,200 has been earning interest for you. As a matter of fact, with inflation right now and interest rates going up, you're actually going to get more interest paid on that money. Okay. And now at the end of the year, when your taxes are due, you just write a check for $200 out of that savings account. You put 1,200 in. Your $1,000 tax refund is right there. It's actually your money that you're getting from the IRS, but you're not waiting for them to send it. You've already got the money. So that's the first thought about taxes. If you are self-employed, a lot of people who I work with a lot of realtors and other people who are self-employed, make sure you're setting aside 30% of every dollar you bring in into a separate account to pay for taxes immediately. You have to write the check for taxes first. I see too many self-employed people who treat their dollar in earnings as a dollar to spend. And that means that they're not setting aside money for taxes. They're not setting aside money even for savings and retirement. And I think that's a fatal flaw. So make sure that if your tax money is not automatically set aside by your employer, that you are setting it aside into a separate account immediately. All right. The second thing, the biggest category is bills. So it's your monthly bills, it's your life. 35% of every dollar that you earn should be spent towards your bills. Now, sometimes we're going to spend more than that, but the reality is our goal over time is to reduce our minimum required payments. So when you think about having a little bit of extra money, and we'll talk about where to spend your money as you're looking at, hey, John, I've paid for all my bills. I've got money that I'm giving. If giving is important to you and you're giving money to charity, that's great. And now I've got 20% left over or 10% left over that I'm saving. Where do I put that savings? And I'll cover that in a couple of minutes on where we spent it. But this is basically the formula that says for a lot of people, tithing is super important, and therefore giving is a key. For other people, it's not as important. My view on giving is simple. If it is important to you, if it is a fundamental value, or it is based on your teachings and your beliefs, then give, give, give. If not, then there's an argument to be said that you need to take care of your own financial house before you take care of somebody else's. I'm not telling you don't give. What I'm telling you is it's the same concept as when you're on an airplane and they say, hey, if the oxygen masks fall from the ceiling, put yours on first before you put on somebody else's oxygen mask because you cannot help them if you're dead. I can't help you with your finances if I'm in financial trouble. So I need to make sure that I've taken care of my own financial house before I'm giving away money to somebody else. Again, I'm not telling you don't tithe. I'm not telling you don't give money. But what I'm telling you is that if you're drowning and you're underwater and you are saying, well, I don't know, I feel like I should give money and take care of other people. And I'm not disagreeing that that's a good idea. But guess what? You're now likely to become one of the necessary recipients of somebody else's charity if you're not taking care of your own financial house. And that's my point. Just make sure that if you're struggling to make this formula work, one of the areas to consider cutting back on is giving. I would not cut back on your savings because that's really the key that allows you to stay afloat. All right, so let's really dive into the 6 steps that I want to cover. So the first step is track everything. Super, super key. So what I suggest that you actually shift your thinking about how you pay your bills, and you have 3 main accounts. You have a checking account that is used simply to pay your bills. So every single bill, every single paycheck you get that comes in, every single bill that you pay comes out of that checking account, and you reconcile it every month. And at the end of the month, whatever money is left over is moved into the savings account because you want to make sure that you've got a person, or excuse me, actually, it's moved into the money market account. Your savings account is your personal allowance. It's spending money. So you say, hey, I just got paid. Most of us get paid every 2 weeks. So when you think about your money, I'm not talking about budgeting from a perspective of, hey, you can only spend this much money for this thing. I'm talking about budgeting from a perspective of, you know what? I need to do a couple things first. I need to save money first. So if you feel like, hey, I can save 20% of my earnings, then the first thing that you do is you take 20% of your earnings and you set them aside and you start with putting it in your money market account. Your money market account serves as your reserve, as your rainy day fund. The key is to build that rainy day fund to three times your minimum monthly payments. So when you think about your debt and you think about, hey, I've got a payment on my house, I've got a payment on my car, I've got utility bills that I have to pay every single month. You put all of that together, those are your minimum payments that you have to make. You need three times that in a survival account, in your money market account, that says, hey, if I've got a bad month, I can dip into that. If I have some, if my car breaks down, I can dip into that. If I've got some extra expenses I need to cover, I dip into that. But we don't dip into our saving, or into our true investments. Let's say it that way. When what your savings account is used for your allowance of things you're going to pay for throughout the month. So you say, you know what, on average, I spend $300 a month between lunches here and there, and gas, and or maybe you put gas on a credit card. That's probably easier to track that way. But the point is, you you don't want, what I suggest is you continue to funnel the money out of your main checking account into the money market account, because that account is one that is only sitting there for a bad month. And then you're going to have investments beyond that, and I'll show you how your investment accounts work. So step two, I'm going to back up for 1 second and say step one includes building the 3 months of survival number. If you don't have 3 months of your bills in savings in this money market account that you can tap into in a rainy day, do nothing else. Don't pay off your credit cards. Don't start paying off your mortgage early. Don't do any of those things until you have 3 months of your survival number in the money market account. Well, how do I know what my survival number is? That's where the budget comes in. That's where you will be able to track every single month. What did I spend? Where did I spend it? How much did I spend? And then that money is what you're targeting to say, I want to make sure I always have three times that in the account. All right, so step two, pay off your credit card debts. That is the second most important step. So when I say you should save 20% of your bills every, or 20% of your income every single month should go to savings, savings includes paying off old debts. So I want you to think about this for a moment. You've got credit cards right now. We all have credit cards right now. That the statistics have shown that credit card debt has ballooned over the last 2 years. As the pandemic set in, people got a lot of money that was given to them by the federal government, and they started spending, and that was good. But they started, now the trickle down of that faucet, that of money coming from the federal government, has been replaced by people charging up their credit cards. And I've seen it myself with a lot of my clients. It's understandable why it's happening, but you've got to make sure that you're paying down those credit cards. And so when you have money, and especially if you have a lot of credit card debt, and maybe you only have 1 or 2 months of reserves, I suggest you take whatever money you have allocated to save that month and split it 50-50. Half the money goes to paying off the credit card debt, and half the money goes towards the actual savings account to build your 3 months of reserves. But as soon as you have all 3 months of reserves, every dollar extra that you have, you use to pay down your credit cards. And I'm going to give you a secret to how to pay down your credit cards, and it's called the snowball method. So you take all of your credit cards and you rank them on lowest balance to highest. And so your lowest balance credit card might have a balance of $500 and a minimum payment of $20 a month. That's the card you want to pay off the fastest. So let's say you put $100 a month towards that card. So you have $20 as a required payment, $80 extra that you're putting towards that credit card, you're paying $100 a month towards that card. That one gets paid off. You just freed up $100. You now apply that to the second lowest balance card. Maybe that one has $1,000 credit limit that you or $1,000 balance, and you were paying $40 a month towards that as the minimum payment. So you take the 80 extra that you've been paying from the beginning, the $10 or the $20 that was going towards the minimum payment. So you're paying $100 total towards that first credit card, and you take that 100 and you add it to the 40 that you're paying on the second credit card as the minimum payment. Now you're paying $140 a month towards that card. That card will get paid off in less than a year because it's $1,000 balance, paid off in like 8 months. Now you have $140 extra money. You snowball. You see how the snowball is building? You take that $140 of extra money and you apply that towards your third largest credit card, third smallest. So you always start with the smallest one because it's the fastest one to get rid of the balance. And now you take what you were paying towards that one and the extra you're paying towards that one and apply that on top to the next one. That keeps your budget stable. Every single month, you're writing the same dollar amount towards credit card bills, but you're able to add them in or layer them in. All right. So Eileen had a great question. Hi, Eileen. Thanks for the great question. What about the percentage of interest difference among the cards? That's really a valuable tool to look at to say, hey, I should pay off the highest interest rate cards first. Financially, you are 100% correct. The problem is in life, we don't think with logic, we think with emotion. And we want to get a win and we want to see progress. And so if your highest interest rate credit card happens to be a credit card that is your biggest balance and you owe $10,000 on it, you're not going to see the win of, man, I paid off that credit card and I'm now able to take that money and apply towards something else. By paying off that small balance, we have the emotional win. We can check the box off on the scoreboard and say, I got rid of one of my debts. Now we're able to take that money and use the snowball effect. So it's more of a tactical process to ignore the interest rate and not pay the highest rate. There are people who are going to advise to pay the highest interest rate. Financially, they are 100% correct. But the truth is, if we lived our life purely financially, we wouldn't have any credit card debt because you never would have charged it in the first place. So I'm a realist when it comes to finances. And in my opinion, you are better off to take a realistic approach, pay off your smallest card because you'll feel the emotional win, and then layer that money in as additional snowball payments towards your next smallest card. So hopefully that makes sense. I appreciate the comment. If I didn't answer your question appropriately, please feel free to comment again or clarify for me. I would appreciate that. So guys, ladies and gentlemen, we again, please post questions. Eileen, I appreciate that. Anita, I appreciate your question earlier. I really want to think and get you thinking about how do we get out of credit card debt as quickly as possible, because here's the reality. Most credit cards are variable interest rates and they are tied to the prime rates. The Federal Reserve controls the discount rate, but the discount rate drives the prime rate. Okay. So the prime rate is going up. We are going to see our credit card rates go up. We saw credit card rates go up. The prime rate went up by 1/4% back in March. Next week on May, what, 5th, May 3rd? No, May 4th, Wednesday the 4th. May the 4th be with you. Yeah. So on Wednesday the 4th, the Federal Reserve is meeting again and they're meeting on the 3rd and the 4th, and they are expected to announce another interest rate increase. They meet every 6 weeks. And this year, the Federal Reserve has projected at every meeting, every month and a half, they're going to raise the prime rates. Originally, they projected 1/4% at each meeting. Then they've been talking about maybe we're going to go 0.5% at different meetings. And now they're talking about we could see 0.75% to a 1% increase in the prime rate just next week. That means that your credit card balances, your credit card interest rates are about to go up theoretically anywhere from 0.5 to 3/4 or 1% next week. So think about that. That's really where you need to be focused. So Eileen had another great question. What's my opinion on using low interest credit transfer offers to pay off highest interest rate cards? I think it's a great idea. There's a catch 22 because when you open up a new credit card, you're having a ding on your credit report. And so for someone who says, "Hey, John, I want you to help me buy a home," that's great. Don't follow this plan because you're going to hurt your credit score. Now, here's the thing: we can't live our life based on how do I maximize my credit score. But if you're about to buy a home, you need to be thinking that way and you need to be talking to me about that. So, in general, Eileen, I think this is a great option. But for a lot of people, they don't have good enough credit to be able to do that. So, if your credit score is good and you can move the money into a low interest card, that might be a good plan. But watch out for the fine prints because often they're going to charge you a balance transfer fee. And I'm seeing some of those balance transfer fees going up pretty significantly. So they might charge you, hey, I'm going to only charge you zero interest for the next 12 months, but you're going to spend a 6% balance transfer fee. Well, then really, yeah, you are saving money, but don't be misled by thinking you're paying no interest or low interest because that balance transfer fee is interest and you're writing a check for it immediately. They're adding it to your balance immediately. But yes, I think that if you have the credit to be able to open a new credit card and get an offer with a low interest rate, go for it, as long as you're not planning on making a major purchase or buying a home anytime soon. The other thing that I'm finding is the economy is shifting. In the next couple of weeks, one of my meetings is going to be on kind of what's going on with the future of the economy. By the way, I do a presentation every Thursday that's really focused more towards business people and realtors and that kind of a thing. It's a 30-minute presentation, live stream like this on Thursdays at 1:30. Everybody is invited to join that. You can go to rsvpwithjohn.com and I've got my consumer webinars, and then I also have on there my professionals webinars, which is the Thursday ones. But in a couple of weeks for my Thursday webinar, I'm going to be talking about the economy. What's going on with inflation? What the heck is happening with recession? Are we heading into recession? What's happening with interest rates and with the housing market? All of these factors really play into what Eileen was just asking about when it comes to the credit cards and paying off high interest credit cards with low balance transfer offers. I see those offers declining in volume, meaning the banks are going to be less and less likely to give you that option going forward. Now, it's a cycle thing. We're in a cycle where the industry is worried rates are continuing to go up. People are continuing to charge more on their credit cards. So a bank does not want to be the one that is stuck holding the bag. And so they are going to be less and less likely to offer low interest credit cards heading into the environment that we're going into right now. So something to think about. Definitely join me on my webinar. Sign up for the professional series if you want. We talk about business issues. We talk about delegation and managing people. And so if you're in a management role, those might be good webinars. You can see all of them on my once they're recorded. You can see all of them on my YouTube channel. So if you're not subscribed to my YouTube channel, please subscribe. And wow, lo and behold, there's my YouTube channel down at the bottom. All right, so credit cards you want to absolutely pay off. Guys, think about return on investment. A penny saved is a penny earned. So if you are not spending 27% on a credit card, then you're getting a 27% return on that money that you put to pay off the credit card. That's why step two, once you've got yourself that 3 months of reserves, is to get out of all of your consumer debt, get out of your credit cards. Okay, step three. And actually, it's forgive me. It's been a couple of months since I've done this presentation, so I didn't realize that we moved it to step three. But step three is building the survival account. So we did make some changes to our presentation and kind of thinking about where people are with the economy and what's going on with interest rates. So it actually is more important right now to pay down your credit cards than it is to build the survival account. And we made that change simply because of the fact that interest rates are continuing to go up. People have ballooned their credit card debt. And so we want to make sure that you are getting rid of that credit card debt as quickly as possible because money that you have in your survival account may earn 1% interest if you're lucky. But you pay off that credit card debt and you are saving 20, 25, 27%. So make sure that you are focusing on building your survival account. Okay. Step four is maximizing your retirement. Okay. If you are not maximizing your retirement, first of all, do not focus on putting money into retirement until you have paid off all your consumer debts and until you have 3 months of reserves. because retirement money is hard to tap into. Now, one of the things I'll tell you is don't leave free money on the table. If you work for someone else and they have a 401k that they're doing a matching program on, you need to participate in that to at least start getting that match, because there's 100% return, 100% return on investment. If your employer says, hey, for every up to $1,000 that you invest in your 401k, I'll match that. That's 100% return on investment. There is no better return on investment. But here's the second most important thing about retirement. It's actually 133% return on investment, because you're not paying taxes right now. So when you put $1,000 into your retirement account, that automatically grew by 33, because if you let that money come to you, if you took that $1,000 instead and had it fall to your paycheck, you would only have $700, because you have to pay taxes on that. So it's an automatic 33% return on your investment by investing the pre-tax dollar. And if your employer is matching, then you need to look at, hey, maybe even if I have some credit cards, I want to participate to get the match. We talked earlier on this meeting about the fact of time being on your side. The earlier you start investing money, and again, for a lot of us, it's too late for us to be at 25 years old contributing $100 a month to a savings account. But we have kids, we have coworkers that are in that age bracket. Forward this video to them. They need to understand the power of compounding money, and that the sooner they can start putting that money aside, the faster it's the bit not faster, it's going to take time, the more time they have for the money to grow. So I think that's super, super important. There's many different ways to do a retirement account. There's pros and cons of Roth IRAs. I will be doing a webinar probably a couple of months from now, where I'm going to talk to a financial planner and dive in deeper about these strategies and what's the difference between a Roth IRA and a traditional 401k. What about the money I had from my old employer? What do I do with that money, and how do I move that money into a better place now? Those are all questions that none of us think about, because it's out of sight, out of mind. And that's why I want to get to the visibility piece here in a couple of minutes. So again, step 5 now out of the 6 steps to financial freedom is to invest in the market. Now you might say, hey, John, wait a second. It's April 29th of 2022 and the stock market has been doing horrible and the market has been going down. That's a good thing, because it means that stocks are on sale. If we go back to March of 2020, we had a huge, huge drop in the stock market and everybody's freaking out. But I'll remind you of something I said a few minutes ago, which is things are never as good as we think they are, and they're never as bad as we think they are. The problem is what I title the human condition. The human condition is that we expect whatever is happening today to continue happening forever. And so if the stock market is going down today in our mind, it's going down forever. If the stock market is going up today, it's going up forever. The housing market's the same thing. Oh my gosh, housing prices are going up. It's going to keep going up forever. That's not true. By the way, I don't think the housing market's going to crash. I'll talk about that on my economic update in a week and a half. Check out my YouTube channel. I've got some videos on what I think is going to happen with the housing market and why I think we're going to see a strong housing market for at least the next 3 years. So I don't believe that the housing market's going to crash, but the craziness that we've been seeing over the last 2 years, people offering $100,000 over asking price, over list price, 30 people competing to buy the same home. That's just not going to happen, in my opinion. That's not sustainable. So sellers are in for a rude awakening, and I think the market is shifting under our feet right now. And I think there's a lot of sellers who still think, hey, I've got the upper hand. There's a whole bunch of buyers out there. There are a lot of buyers, but those buyers are more reserved right now. And I'm not, I'm literally thinking about data that I'm looking at up to the moment, and I'm seeing changes in patterns. I'm seeing changes in how buyers are thinking right now. And I think we're going to shift into still a seller's market, but a little bit closer to a balanced market where houses are going to be listed on the market longer. Sellers aren't going to get top dollar like they think, where they can get 100,000 more than what their neighbor sold their house for. But all of this comes back to, is this a good time to invest in the market? The best time to invest money in the stock market is today. Okay. Well, the truth is, the best time to invest money in the stock market was, 25 years ago. The second best time is today. And it's what's called dollar cost averaging. You don't try and dump a whole bunch of money in the market at the same time, because that's when you are guessing and you're saying, I'm going to pull money out and I'm going to put money in and I'm going to shift over here. No, you simply you invest in things that you believe in. Okay, so there's two real key strategies here. You can pick, you obviously need to be diversified. Pick a mutual fund that has an average of, actually, I think we had a typo here, of at least 10 different stocks. And you can get a couple of different portfolios by talking to a financial planner. But it's super, super important that you are putting money in regularly, because whether the market goes up or down, you're continuing to buy shares. You're continuing to get a little bit of ownership. If the market goes up, it looks great because your money has grown. Problem is that the money you're throwing in there doesn't buy as much because the market's gone up. If the market goes down, it's great. It's bad because it looks like you've lost money. You haven't lost anything because you're not selling. But what you've got is a discount. Everything is on sale and you can keep buying. The key is to have the discipline to invest every month, regardless if it's gone up or gone down. And that's where emotion will kill you, because emotionally you're going to say, oh my gosh, I want to pull the money out because I think the market's going to crash, or I want to put all my money in because I think the market's hit the bottom. None of us can predict the future. And these trends, you can see, hey, the market's going to go a certain direction, but you never know when you hit the bottom until it's past. You never know when you hit the top until it's past. So take emotion out of it and just have the discipline, the tactical discipline to invest money every single month. And it's the same dollar amount every month. So when we talk about saving 20%, once you've got your debt paid off, you've got your 3 months of reserves, you're now putting some money into your 401k. And now when you think about that 20%, the rest of the money goes into investing in the market. The last step is paying off your mortgage. And I will tell you today, this is a horrible idea. Okay. It is absolutely a horrible idea. Let me say this again. Do not pay extra on your mortgage today in most circumstances. Now, I'm going to break my own rule. I just broke my own rule. I fixed it by saying in most circumstances. But no advice is applicable to everyone in every circumstance. So you've got to take everything you hear online, everything you hear from anybody with a grain of salt and say, are they talking about me or are they talking in general? I'm not talking about you. I'm talking in general. In general, your interest rate on your mortgage is likely somewhere around 3%. That's what the average rate's been over the last 2 years. And if you're one of my past clients, I helped you refinance over the last 2 years. If you're not, hopefully you were able to refinance over the last 2 years. If not, give me a call. We can talk through your situation. But the fact is, inflation is going up by way more than that. Today, the inflation report came out and it was 5.5%, better than what it had been last month. So that's a good sign. But the truth is, you're paying interest on a mortgage less than what inflation is going up. You need to invest that money. You need to, any money that you've got, you need to invest it, not pay down your mortgage. That money will grow separately, and then you can take what it's grown in the market and use that to pay off your mortgage. But paying a little bit extra every month on your mortgage right now, even if you've already satisfied the first 5 steps and you've got a bunch of money going to the stock market and you're saying, hey, now I want to start paying off my mortgage. The only time that I would say you want to look at that is if you're in a position where, hey, I've got a high amount of earnings coming in and I'm at about the point where I want to retire in the next 5 to 10 years and I can get my mortgage paid off completely. That's about the only time in today's high inflation environment that I think it's a good idea to pay off your mortgage. Otherwise, a mortgage debt is good debt. So don't get rid of good debt. All right, so I've got about 10 minutes left. Feel free to ask me some questions if you have, post them on the chat. If you are watching the recorded version, post them in a chat or you can email me. I don't know if I have my email in here, but my email is kingteam@johnloanking.com. So if you have a personal question, you don't want to post it. We're talking about finances, we're talking about your money. Feel free to shoot me an email, and I'd be happy to talk to you about that. So kingteam@johnloanking.com. What I want to spend the rest of the 10 minutes on, other than questions that you guys may have, is this personal budget. And this personal budget is a form that I use on a regular basis that helps me track where my money has gone. And it helps you prioritize, and you'll be able to see how much you're saving every single month, or at least where your money is going if you're not. So, Anita, you said you wanted to get to enhance your financial goal setting skills and your retirement plan. This is the tool that is going to do that. So let me go through this with you. Email me or put in comments your email address, and I will send you a copy of this. It's a simple Word Excel document that you can use to keep track of your finances on a monthly basis. And so there's 5 columns to this. So the first, let me move here. All right. So the first column, you're just putting the name of your bills, and you customize it to your life. And so you got a lot of different things. Hey, we got dry cleaners, we've got college tuition, all of these things. And you put your balances of your biggest debts. So your car loan, your mortgage, your credit cards, you're putting your balances in column number 1. And then column number 2 is your minimum. These are recurring expenses, not one-time expenses. And so if you have an auto repair bill, that's not a recurring expense. That happened once. Your Netflix, that's a recurring expense. By the way, here's a tip on Netflix: steal somebody else's password. Totally kidding. Sorry, but that was timely because Netflix is making a big deal about about password sharing. Eileen, I'll make sure to get that over to you. Perfect. Your recurring bills go in number 2 because that's your survival number. A bill that is variable. Let's think about your utility bills. Your electricity, your gas, and electricity go up and down depending upon what time of year it is and whether you're running the air conditioner or whether you're running the heater. So average it. Say, hey, on average, I spend about $150 a month for utilities, because your survival number is an average. Column number 2 is it comes out to a grand total of your survival number, and you're going to average those kind of things. Even things that you do that are optional, but you know you're going to do them, like get my nails done every month. I get my nails done every single month. Can't you tell? Yeah, not at all. But you get your nails done every month, then that goes into column 2 because that's part of your budget of money that you're going to be spending. And then you add it all up, and that is your survival number. Every month, your survival number should be pretty close to what it was the prior month. Your life goal, as we think about this as a game, your goal is to get the survival number as low as possible. So you want to, chunk down on things like when you have extra money. What's extra money? Anyway, when you have extra money, I said don't pay down your mortgage, but if you're doing all the other things, you're investing money in the stock market, all of that kind of stuff, pay off your car. Take your car loan and say, hey, you know what? I can put an extra $500 a month towards my car. And if I do that, I'm going to pay off the car in a year and a half instead of in 5 years. So I'm putting $500 a month extra. That decreases your survival number. Now you can take the money that you were paying towards the car, and that's extra money that gets to go into savings. Column number 3 is where you're going to put the money you actually paid. So as you look at this, you're saying, hey, my credit cards, if we look at the credit card line, it's the 4th line down. I know it's kind of small, but let me see if I can make it a little bit bigger. So the credit card line, it says, hey, my balance on my credit cards is $5,250. My minimum is 250, but I wrote a check for 4,000 because I'm paying extra to pay down my old credit card debt. And so you're putting that in column 3 as the total you paid. But column 2 is just your minimum payments. Even if you pay more than your minimum payment, I recommend that you put in column 2 the minimum payment, because your survival number doesn't require you to pay off the debt in full. Not encouraging you um, to have extra credit card debt. What I'm telling you is, when you think about how much you need to have in your survival number, 3 months of savings to cover your survival if things go bad, you only need to cover your minimum payment on your credit cards. So don't overthink it and put the total of your credit cards in the minimum owed, even if you pay them off every month. The minimum owed is really the minimum owed in column 2. So column 3 is going to be, how much did I actually pay? That's also where you're going to put things like one-time expenses, because, hey, this month I actually paid extra for something. I paid extra for car repair. I went on a vacation this month and I spent money on that vacation. Now, you can do a budget for vacation money and say every month I'm going to put $500. In this case, if you look down at the bottom, they have a vacation fund, third from the bottom. And that vacation fund says $450. Every month I'm putting $450 into my vacation fund that has been pre-allocated. If you like budgeting that way, go for it. But remember, I told you in the beginning, the budget I'm going to teach you is not one that says you have limiting factors, that you're handcuffed. It's simply about visibility. And if you can get disciplined about writing down where your money is going, you're going to be significantly ahead of the game and being able to plan for your financial goal setting and your retirement plan, as Anita had put it. So column 4, this is the best part. This is my favorite column because this is where we're putting money saved. Now, money saved is literally money that you had put into your savings account, but there's some extra things that you get to count. And this is all about winning the game. It's about, how do I find a way to make sure that I save at least 20% of my income every single month? And as I put here on the first bullet point, the exciting news is that if you pay down debt, it gets to count as savings. And that sounds kind of counterintuitive. But let's think about an example where you say, hey, you just went out and bought a car and you owe $10,000 on the car. And the minimum monthly payment is $250. So column number 2, you put $250 as a minimum owed. But you're going to pay $1,000 a month because you're chunking it down and paying it off faster. That will help reduce your survival number so that in a rainy day, when things go, when something happens and you don't have as much income as you thought you were going to have, you don't have that car payment anymore. So you're taking that extra $750. We get to count that in this game of our budget as savings because you've saved money by paying down debt over and above the minimum. So you put amount saved in column number 4. If you're getting money into a 401k, then that money goes straight into column number 4 because that money never touched your actual bank account, but you did get to count that as savings. So don't lose track of the 401k money. And then column 5 is your income. So you're looking at, hey, how much money did I bring in that month? And now we're going to summarize it. And we're going to say, hey, where am I at from a savings perspective? Anita, again, I'm going to keep using you as my example. By the way, guys, we've got about 2-3 minutes, 4 minutes left. So if you have questions, feel free to post them right now. I'll be wrapping up here. I want to make sure I end on time. If you want to get a copy of this budget, email me at kingteam@johnloneking.com or post in comments and I will get you an emailed copy of this budget. So here's where you're tracking, Anita. Where are your balances at? One of the things that I think people do, there's two extremes. You're either looking at your investments every single day and freaking out, oh my God, it went up. Oh my God, it went down. Who cares? Okay. You own some shares of a stock. You own shares of a mutual fund. You don't need to freak out because, oh my gosh, that value went up or down today or tomorrow. But once a month, you should just take a view of, where's all my money? How much do I have in total? Okay, it went down. Okay, it went up. What's my equity in my home? How much is my equity in my rentals? All of these things that we need to pay attention to. And then we're reconciling this, saying, how much money do I have in my money market account? What am I supposed to have? So this money market float, that's 3 times your survival number. So you're putting in there, hey, my survival number, I need $4,000 a month to live. Then your money market float is how much you're supposed to have, which would be $12,000 if you had a $4,000 survival number. And then you're just summarizing everything. How much did I save this month and what percentage was it? How much have I saved so far this year? How much have I given so far this year? These are things that allow you to keep track on a monthly basis of where you're at going towards your goals. And this is really what the numbers look like. And so you're flowing the numbers to the bottom of the spreadsheet. And so you're basically saying, hey, my survival number is 7,800. 3 times that is the 23,000. My column 3 and column 5 always have to match. So you think about, hey, you've got to allocate where every dollar went. So if I brought in $8,000 in paychecks, then that $8,000 has to be allocated. Where did it go? If it didn't get spent, then it's savings. So you need to allocate that to savings. Hey, I paid money into my savings account. I've allocated every single dollar. So your column 3 and your column 5 always need to match. And then column 4 is your total amount saved for the month. And you see the arrow down there that points down towards the amount saved this month and the percentage. Hey, I saved 10,000 out of $18,000 we brought in this month. And so I've saved 59% of my income this month. Okay. So, guys, that's the end of my story. So, if you have any questions, please feel free to ask me those questions. I again watch this broadcast again. There's a lot of good information in here. I am absolutely willing to look at your budget with you to help you understand how to use this. So that is obviously optional. But if you're in a position where you like what I've shown you and you say, John, I want to understand how it works, I'd be happy to set up a one-on-one 30-minute call, Zoom call, where you can show me your budget and I can show you how to add the numbers properly, where to put something in there. I'll keep that completely confidential. The truth is, I already know everything about you and your money because you trust me to help you out with your mortgage. And I want to be here to help you out in getting out of debt and helping you to build long-term wealth. And so that really is my focus: is being an advisor, being a consultant, but really being that trusted friend that says, hey, you need to shift your way of thinking. And the first thing that I'm going to recommend is you shift your way of thinking when it comes to how to track your money. People freak out because they don't want to be told what to do. Nobody wants to have a budget that says you're not allowed to spend more than X amount of dollars. But hopefully, you see this budget doesn't say what you're allowed to spend. It tells you where your money went, and it's giving you some incentives to say, hey, let's try and save some money. Let's try and pay down some debt. Let's try and pay attention to where our money is going, because when you pay attention to it on a monthly basis, it doesn't just disappear. We unfortunately all embezzle from our own personal finances. We spend money on things that we aren't paying attention to and we don't know where it went. So that is my recommendation to you guys. Thank you very much for indulging me for the last hour. Hopefully you got something out of it. Please make sure to subscribe to my YouTube channel. I need more subscribers. I appreciate that. Yes, Eileen, I saw that. I'd happily give you a call. I'll call you in a couple hours. I've got a couple appointments coming up right now. But everybody, appreciate you. Have an absolutely amazing day, and we'll talk to y'all soon.